everyone, and welcome back to the conversation. My name is Michael Barnett, your host, and today I am joined by Marcell King. Super excited to have you on the podcast today.
I'm excited to be here, Michael. It's been a long time to pull it together, but we finally did it. So excited.
Absolutely. Marcell is the president of Incent, a youth digital banking platform, and looking to hear a lot about Incent, plus also, Marcell, how you got to this point in your career. As I mentioned in private discussions a couple of weeks ago, really look up to you, the things that you've been able to accomplish in your career, and was really looking forward to you joining the podcast today to talk a little bit about your story and also to talk a lot about Incent, which is a mission-driven organization. So the idea today is to talk about empowering youth through financial literacy. And like you, I share a similar history to you as growing up as a small child, coming from a family who didn't necessarily have the tools to provide financial literacy to me as a young person, and then needing to kind of learn that information through trial and error and mistakes and charging up credit cards, not understanding what credit was, ruining my credit score, building it back as an adult, and just a lot of little things that should have known could have known as a young person about how to manage money, how to balance a checkbook, if you will, if anybody out there is still writing checks. There are some people who still write checks, by the way.
I know none of our kids do.
Right. But there's a lot of information out there, but there aren't enough people that are sharing the information and almost force sharing the information to young people to educate them on financial literacy. I know that's something that you're passionate about. There's a number of reasons why you're passionate about that, and I'd love to discuss that today. So, Marcell, if you would, I would love for you to kind of share your personal journey and kind of what was the root of inspiration to get you to this point where an idea and concept and strategy like Incent was so inspiring and motivating to you.
Yeah. I'm going to start from the beginning, but try and keep it real brief. I was, born and raised pretty much out of Compton, right? My mom was 17 years old when she had me. We were living in Compton, and she graduated high school, but never went to college. I'm a first generation college grad. My dad didn't go to college. My grandparents didn't go to college. So, I grew up in Fairbanks, moved from Compton to Fairbanks when I was about 6 years old and grew up there and played a lot of sports. Fortunately enough, I was able to get a scholarship to Boise State, played football there. And the first day of school opening up.
It's a really big deal, by the way. Get a scholarship to Boise State. It's a great school and an amazing football school. So you had to have been excellent to get a scholarship to Boise State. Okay.
It definitely requires some skills. So luckily I had them. I was blessed with some athletic skills. Growing up in Alaska, sports was my outlet. I played sports every season, football, baseball, ran track. And the probably most interesting one is I played hockey. All right, wow. So I grew up playing hockey in Alaska. That's another story. We'll come back to that one if you want to.
Okay.
Yeah, so that was my outlet, was playing sports. And I had an opportunity to go to school, secondary, go to college, either on a football scholarship or a hockey scholarship. And I chose football. And that's how I ended up in Boise. But the first day of school opening, student union building, of course, you're going in there, getting your meal and stuff. And of course, there's 5 or 6 booths of banks and credit unions in there, giving away credit cards. They're basically giving them away, right? There's $200 or $300 limit, but I go and get the card. I'm like, wow, okay, I get my first card. It was a Bon Marché, which was a department store in Boise, and I had no idea. I was like, okay, it's free money. Right?
Yeah, great, let's go.
So I'm going to go shopping, get some clothes, some tennis shoes, some kicks, and and then never realized. So I have to pay the minimum balance, and after a while, it was like, okay, it's either $20 going here or $20 because I need to go get some lunch, and never even thought about what the impact would be. And of course, over time, as I graduated, now I'm starting to apply for a car loan. My credit score is like 40. It probably wasn't that low, but close enough, 400, right? Whatever it may have been. And that's when I realized the impact of credit, right? Never was taught that in high school, we had a home ec class where they taught you like how to balance a checkbook,
Yeah.
how to make your lunch and your dinner, and
How to
maybe,
cook,
yeah,
right?
how to cook, and
So,
so exactly right. So they got soda pillow.
yeah,
Uh,
so the pillow.
so, yeah, so never got it in high school. My parents didn't have any perspective on that because they were paycheck to paycheck. You have three younger brothers, and they both worked two jobs, right? They had to. It was about making sure we had housing, safety, and food. That was their core goals, right? So they didn't have it, we didn't get it. Even getting into college, I have a my undergrads in marketing with an emphasis on finance. And even, going through the finance classes, they teach you all about econ 101, debits and credits from an accounting perspective and things along those lines. But, they never taught personal finance, right? Or personal, financial education or whatever it may be, right? So I learned like you on that trial and error, mostly error side of it. That's how it was. And I think when my wife and I got married and we're trying to buy a house, and that's when it really had, some impact. So I'm thinking, wow, we really screwed up. Well, I screwed up. I screwed up. So after that, it's just taking that next probably 6, 7 years to correct all the stuff that, I had done. And in terms of financial illiteracy, judgments, late pays, 30, 60, 90, 120-day charge-offs, all those kind of things impact, your credit. And so, of course, I was able to have enough money to put down on a house, but my interest rate was, through the roof, right? So that's when I really started understanding about credit. And I got into fintech, ironically, through college. It was an internship. And it wasn't necessarily financial management. It was more just technology and moving money. They built ACH origination and cash management software for community banks. So that was my first gig in fintech back in like 94. And, when you're early, it's all about the money, right? So I'm just trying to figure out, okay, how much money can I get along the way if my career progresses, et cetera. And then I think where it really shifted to, okay, I need to actually be doing something for a purpose, not just for a paycheck. And so the last company I worked at before Incent was a company called Payveris. And Payveris was a bill payment. They built bill payment and peer-to-peer and account-to-account transfer technology for banks and credit unions. And as as you get older, you start thinking about, okay, what do I want to leave behind? What do I really want to contribute to this world and to humanity? And I just started thinking about, technology as a way to help educate. At that time, it was really the adults, because bill pay is mostly adults that are making bills, right? And paying bills, online. So it was online bill pay for banks. And so you can go into your mobile app or your desktop, and you can pull up your bills and you can make your payments, et cetera. So that was the product. But then as I started kind of just reflecting and then started researching financial literacy, is where it really started to hit home, and understanding the kind of dire straits of the U.S. population. There's lots of data out there that's talks about most people, or say somewhere in the range of 62% don't even have $400 in their savings account for an emergency, right? That single emergency can shift the path of that individual or their entire family in an entirely different direction, right? Just because they can't pay to fix their car. Now they can't get to work on time, and now they get fired because they can't work. Now they're on unemployment, and now it's putting more stress on one of the other spouses that are trying to keep things together. And it just continues to roll and snowball and escalate. And so I started thinking about, okay, well, how can I apply this bill payment functionality and capabilities to something that's going to actually help contribute to better financial health? And I ended up doing some research, found an organization called the Financial Health Network. They are a nonprofit organization founded and funded by, I won't say founded, but funded by big banks, fintech companies, et cetera. And they give insights and lots of they do a lot of research on the financial health of the U.S. population. And they rate you based on kind of 4 categories, 8 questions. And the 4 categories were around spending, saving, borrowing, and planning. The first bucket was spending. And the 2 questions that you ask yourself to determine immediately, are you financially healthy, is 1, can you pay your bills on time? And 2, do you spend less than you earn? That pay your bills on time became kind of that anchor of, how do I take this bill payment and this pay your bills on time and try and apply this to this kind of financial goal. And we ended up building out a tool that wasn't just here's your bill, here's your due date, et cetera. It would provide my reminder. It would allow you to kind of determine what the best way to pay down debt. So kind of that snowball payment kind of philosophy. So we just started thinking about how do we tie the bill payment into that, making sure that people could pay their bills on time, notifying you ahead of time if you're spending too much money at Starbucks, hey, you're not going to have enough money to pay your bill next week, right? You want to pay it now? Press yes, done. Okay, now it's out of the way. Now you can go spend buy you one Starbucks instead of 8. So that's how I kind of got into it. And then over time, with Payveris, that company I was with, we built up the user experience to try and leverage as much as we can to kind of facilitate that on-time payment, and also trying to understand how much are you actually, how much do you make and how much do you spend? Because really focus on that one bucket, but we really couldn't do it. And so when I joined Incent. Actually, I take it back. I joined Typhone, which is the parent company of Incent, provided the full digital banking experience. That's when I said, okay, this is great. We're providing the entire digital banking experience. That is the front end to that financial education and literacy, because now you can have access to not only their income, but what they're spending, where they're spending it, how often, how many accounts they have, all the things that you need to get a full picture on somebody's kind of financial space and health and kind of where they are. And so it just kind of grew from there. And then eventually over time, we did some research and said, all right, we actually need to start with the youth. And that's the base. And that was the catalyst to acquiring Incent, the youth banking solution, to really start from that base. And we're going to dive deeper into the functionality, but that's kind of how I got to this point. And that was, we acquired them back in January of this year. And now we're starting to kind of build additional capabilities that just, again, with the focus and mission on how do you help drive financial health and education and knowledge so that you can be better and just be in a better position, throughout your life. So that's kind of how I got here.
You are focusing at the root of the cause, which is at the beginning. So when someone is just kind of starting to work, maybe a teenager gets their first job, and to have an app and a tool and a resource that helps them understand how it all works. Like, can I spend before I earn, which is a kind of a big problem that we have here in the US. Overspending.
Yeah, okay. Absolutely. Well, in fact, it's interesting. So talk about teens, and there are some products out there kind of focused on teens. We're actually getting to them even earlier than that. I just this morning had a call with one of our clients, and he was giving us an event that happened with he and his 9-year-old just this weekend, over the weekend. And so he is at an institution that uses our product, and the kid wanted to buy a fish. Right. And of course, the fish is about $15, right? But then you got to get an aquarium for it. Then you got to get the gravel for it. Then you got to get all this stuff for it. So it ended up being $135 or something like that, right? That going out the door. And so, the learning experience with this kid was, okay, I'll pay for half, but you need to pay for half, right? Okay. And now the kid has to start thinking, okay, do I really want this? Right. And I've got enough in my account, but do I want to spend all of it on this fish? Right.
Correct. Like I just wanted the fish part.
Exactly.
But the other stuff too. Ooh.
Right. Yeah.
Right. Yeah. So how bad do I actually want that fish? Which is I think that is the right way to learn, because I mean, as an adult, right? It's like, okay, well, I have this mortgage payment. I've got to pay my energy bill. I've got to pay the necessities, food, shelter, etc. But then there are the other things. So it's how much do you really want those other things, right? Because you have to really want it, because in order for you to potentially extend yourself to purchase those other things, the trip to here or the new TV or, as we were laughing at earlier, the person to do the landscaping of your home, or you get out there and you do the landscaping right in front of your house. Right. So the perfect place to get to people is at their youngest point. Yeah. And I opened my first bank account, I think I was 11, back when they had passbooks. They
Mhm.
still have passbooks. They had to get you a little
Yeah.
passbook. I was able to walk to the bank, deposit $3,
Mhm.
right? Get some allowance or go wash a neighbor's car, make $7 or $8. Could walk over to the bank, deposit it with the passbook. You could see how much money was in that account. Every time you kind of went to the bank, they printed it on the passbook.
Right. We're
But
aging ourselves.
right. Exactly. But I think tools for youth is super important. And then for all the parents out there who were watching, when your son or daughter goes to college, for those who have sons and daughters that end up going to college as freshmen, when they get on that campus or university campus, there are organizations there, banks. I won't name the banks, but they're all there.
Mhm.
Okay. And they give away cool stuff, as Marcell mentioned a few minutes ago. Cool stuff.
Mhm.
It used to be CDs, CD holders, koozies, and other stuff that they would give away to just fill out this application for a credit card. And then the credit card comes. It's got a limit of $500, $1,000.
Good.
Your son or daughter is not going to tell you about that credit card
Of course not.
until maybe until the bill needs to be paid and they don't have enough money to pay the bill. And if they tell you, you've got a great one.
Right. Yeah, true.
Most of them aren't going to tell you. You still might have a good one, but then those cards go into collections, and then those collections can turn into maybe a judgment depending on who the organization is. And then that drops and lowers the credit score. And that then can prevent your teenager from doing things like, even some cases, opening a bank account.
Mm-hmm. Or getting a rental. Like you're the
Getting
first
a
year
rental.
you're in student dorm, and the next year you need to get a rental. There's credit checks.
Correct. Getting a rental, or in some cases, getting a job, depending on where you're looking to work.
Right.
So there are life implications for making a very small mistake, or what seemed to be a small mistake, as Marcell mentioned, can snowball into something larger. So this is a really important one today. Financial literacy and how to manage your finances and credit. Super important for young people, but even older individuals who didn't get that training, coaching when they were younger. Also really important. I'd like to talk a little bit about the gap in financial education in the schools. So what from your research is happening today in school? And I guess what are some of the things that, from your opinion, that could happen? What are some of the things that we can do? When I say we, I mean the country we can do to better educate our youth in financial literacy? And then what are some of the things parents can do to help their children? And even parents who may not have the literacy or have had the literacy, how can they help change things for their children?
Yeah, that makes sense. So maybe just kind of level set on a couple of kind of key data points that are out there. As I mentioned a little bit earlier, approximately 60-ish or so percent of consumers don't have $400 in their savings account. 57% of U.S. Households, only 57% are considered financially literate, which means that 43% of the country is financially illiterate. And there's, some very basic questions that are asked by these kind of survey researchers to determine whether you're financially literate. And it could be, do you know how interest works? Something very what we now believe is simple, but for those who have no concept of it, it's not simple. Um, and that number of 57% really hasn't moved over the last 50 years, right? This been research on this for a long time, and I think the biggest challenges are, like I said, the kids, if their parents don't provide it to them at an early age and help them kind of understanding money, even just earning money, and what it means to earn money to begin with, and the value of money. I started a niece who was with us for a while, and she just thought, money was just swiping the card. My kids, when they were young, I remember a time where my daughter, I think she was 8 or 9 years old, and I said, "Well, I don't have any cash." She's like, "Well, what about that plastic thing?"
There's money in that. This
I'm
inside of
getting
that.
something. When I see you swipe that, you're walking out the store with something. There's something going on, right? But they don't really understand the concept. So when you start thinking about earning, budgeting, interest, and how that applies to not only your credit score, but the extra interest that you'll pay if you don't have a good credit score, right? How much more money you're going to pay. So there's just challenges. Like I said, it's not taught in high school. Well, historically had not been taught in high school or in college. But there's legislation and laws and bills that have been passed already for, I believe it's 26 or 27 states are now mandating that kids graduate with some form of financial education, meaning the schools have to now provide some form of financial education, and the kid has to take it as a core course before they graduate. Now, a lot of these states haven't provided how that's going to be funded or what the curriculum looks like. I mean, it's very vague based on some of the conversations that I've had with some of the credit unions and banks who do now offer financial literacy education, either through high schools. For example, a lot of the credit unions, core to their mission is to obviously help strengthen the local community. And one of the pillars in that is to strengthen financial literacy, because if you can strengthen that financial literacy and education, that helps support and strengthen the community. And so they will provide educational courses in high schools now. So a credit union may partner up with a school district or high school or whatever it may be and go in and teach financial education within high schools, right? So credit unions are contributing to this. Banks are doing it as well. I don't think at the same level, because credit union, community institutions, I would say.
The mission's different. The mission's a little different.
So. Yeah, just a little bit different, right? Different mindset, different kind of philosophies, but definitely see a heavy lift of credit unions actually participating in financial education at the high school level. They're also participating even at the adult levels. They'll do webinars, they'll do in-branch presentations, whether you're 12 or you're 70, right? They're even now doing financial education for the elderly, right? In addition to that, how do you make sure that you maintain security around your finances, right? Especially for things around fraud, right? So there's a lot of that taking place in the market. But I think the biggest challenge right now is the ability, because that's been going for some time now in school financial education by credit unions, et cetera. Again, even that's difficult to understand what the impact is, because there is no way to tie that financial education to actual change in behavior.
So right now,
I've talked to a lot of institutions that I asked them, how do you measure the success of your financial education programs? The number one is participation. So how many people do they get, which is great. That's fine. Number two is either some form of post class survey or test, which again is great. But then the question, does that change the behavior on the back end? Right. And I think that's been one of the biggest challenges of really understanding is what we're giving to these individuals who are trying to get better understanding financial education. Are we giving them what they need to actually change their behavior?
Right? I have an idea.
Yeah.
I have an idea. An idea would be to measure the number of Incent users, and then Incent, using its, of course, data research, can use its data and tools to map the trends,
absolutely,
right?
Absolutely. And that is actually one of the things that we will be focusing on, because we know who's participated in the online education, and we can look at what their history of transactions were and their savings balances and things on that lines before they took the test. And then once they took the test, what's the change in behavior, right? Did their savings account go up? Did they start spending less? And now you can start iterating on the education side of what's going to drive that change in behavior. Right now, there's no way to measure the correlation to that education, but now there is.
That makes a lot of sense. So I'd like to know what sets Incent apart in your space, because there aren't a lot of players in your space, and I know there's some core features, functionality, and potentially even the way that the business is managed that may be different than others that are in the space. Would you mind sharing a little bit there?
To give it context, right? So the whole youth banking kind of market sector has been around, I would say, probably for the last 7 or 8 years, right?
Okay.
There are, it feels like every week there's a new one, but the big 800-pound gorilla in that youth banking space is Greenlight. And Greenlight is basically a teen banking, digital banking solution that allows a parent to open up an account at Greenlight, put money in that account, open up the kid account that's tied to the parent account. So now the parent has the ability to kind of monitor, right? Initially monitor and then control the spending on the debit card that is associated with that account for the kid. And then there are others like Busy Kid and Go Henry and Step and Till and Goal Setter. So there's a whole bucket of that we call them B2C fintech companies. They're technology companies that have connected into a bank or banking system to facilitate banking services, but they're not actually the bank, right? And like a Chime's the same way. Chime is a bank technology. We call them fintechs, but they're not technically a bank. They have a bank that sits behind them as the engine that's running the bank and all the regulatory stuff, right? So for traditional financial institutions, credit unions and banks, whether it be a America Credit Union or Star One or ViStar or Jovia, or could be a teachers credit union, all these different credit unions. Those institutions are being disintermediated by the fintechs, right? These kind of financial technology companies. And so when you open an account with Greenlight, you're moving money from your bank where you primarily bank from into a Greenlight account at what they call a sponsor bank. And that money sits in that sponsor bank. And therefore, when the kid starts to use the debit card, there's what's called interchange, which is revenue that is generated whenever you swipe your card at, whether it's Albertsons or 7-Eleven or AMC or whatever it is. The institution gets revenue every time that card gets swiped. But in this case, it's Greenlight. They're the ones who are generating that interchange because it's at their sponsor bank. It's their card. So that's now taking deposits out of the traditional institution. It's taking the interchange from the institution.
Right.
And then thirdly, it is building brand loyalty. The kid is now recognizing Greenlight as the product and the bank that they're running their credit card, because they're pulling out that card, they say Greenlight. Okay, all right, Greenlight. And that becomes top of mind when they're ready to move to the next level. They turn 18. Where do they go? You could potentially stay at Greenlight. I'm not saying that Greenlight's going to stick with the youth banking. Many of them many of these fintechs start with smaller service sets and expand. So that's the model. So that's the challenge. That's what Greenlight has been offering. They partnered up with, believe on their website, they say about 100 institutions. And again, the challenge with that for the institution is it's pulling dollars out of the institution, core deposits, the interchange, et cetera. And since primary business model is financial institution centric and beneficial, because we allow the institution with the same set of, call it youth banking services, like card issuing and parental monitoring and savings goals and parental lending and all the features. We wrap that around the bank, the traditional bank or credit union's existing infrastructure, so that they retain those deposits, so that they retain the interchange that's generated, the revenue that's generated on those cards and those debit cards. So it allows them to keep that. And it also allows them to keep that relationship because they can white label the solution. So it's not a Greenlight solution, it's a Jovia solution. Yeah, right. Or it's a Capital Educators Credit Union solution. They call their program RISE. I believe our RBFCU out of San Antonio, they call theirs STAR program. So they get the brand, their own product, but it's within the STAR umbrella, or RBFCU or the Jovia or the Cap Ed. It gets to stay inside of that institution. One of our clients, Desert Financial Credit Union out of Phoenix, does a fantastic job with their marketing. If you go on their site, they have kid branded debit cards, right, with Desert Financial on the name. So now the kid, as he or she kind of goes through that journey until they turn 18, they've been seeing Desert Financial the entire time, not
Their
Greenlight.
entire life.
Now they just flip into the next experience. We call it kind of life cycle banking. So it all stays intact.
Well, this is great, actually. So this strategy, the Incent strategy is multifold, right? One, providing tools, the technology to better youth financial education. And as you continue to improve and get better at what you're doing as an organization, all of your subscriber banks also get better.
That's
right?
exactly.
And so it's a huge benefit to any institution, any credit union, regional bank, local bank, national bank, who is looking to add this feature to their set of features. Everyone should, by the way. Every bank should adopt this technology. Shame on you if you haven't, by the way.
Yeah, absolutely. And if you don't, then that just means that you don't necessarily care about your youth, because that is the next generation that will be supporting and helping these banks, generate the services and revenue that they do, right? So,
Correct.
The average age of a credit union member is like 53 now and continues to go up, right? And a scary data point or kind of metric that I learned probably several months ago was 47% of all new accounts opened in 2023 were opened by pure digital banks and fintechs. And it's because they are able to personalize that experience specific to a demographic or affinity and create that personalization and create that stickiness. And so that means that half of those accounts are not being open in a traditional institute, and that's continuing to grow, by the way. So they have to have something to compete and to stay relevant. And this product gives them the ability to be relevant to the youth. And give
this
them
is huge.
Experience.
This is really important. And this is even for homes and families who have financially competent adults who are the leader of those families, but even those who don't. A tool like this for your kids is super, super important. And for my kids, I used to use a bank called ING Direct, right? ING Direct was kind of like, in my opinion, it was the first kind of cool bank experience for me as a young person. It was like 20 years old. I opened an ING account. I'm like, this is cool. ING Direct, they sold that part of their business to Capital One. But they kept the whole kids savings, very basic financial tool, like super basic financial tools. But things like you have an allowance, track your allowance, you get paid, you can see your expenses, you can give a debit card to your minor child. You can set limits and goals and all that stuff. So it's super basic stuff. Nothing compared to Incent, but super basic stuff. And so I implemented that for both of my kids. Now, my older child, he still has the Capital One account as an adult. So great for Capital One. They were able to retain a customer. But for my younger son, he still has his Capital One now account as well, and still utilizing the debit card, et cetera, et cetera. So I think
the likelihood that he will stay is pretty high, because there's friction to go open up another account. Why? Just keep your same account. Maybe you get a different debit card doesn't look like a Pokemon or whatever it is, and
exactly,
you move on.
Exactly. So really cool. I think that every parent should also look to provide this type of resource to their child. I think every bank should adopt this type of technology technology and implement this strategy as a part of their feature set. As I mentioned a moment ago, shame on you, Mr. CEO of a bank who does not have this as a part of your roadmap. If you don't have it already, you need to. Okay. Because you want to get to your clients early. But number two, we need financial literacy, education, and financial responsibility in this country, right? It's a big problem. It's one of the reasons why credit scores are so low. We have defaults in some areas are so high, and banks want to lend money, right? And you want to lend more money to the right people. Well, let's create more of the right people by starting making change.
Absolutely.
So that's my argument here. Right. And also my closing argument is that I think really important. What you're doing, Marcell, is great work. It's very important work. The work benefits parents, kids, future parents, and the institutions that are ultimately responsible for the money, right? The banks.
Right. Yes.
So I think what you're doing is amazing.
Thank you. I appreciate it. Appreciate it. I'm enjoying it. I'm really enjoying it.
Would you mind leaving us with some parting advice, one piece of financial advice that you wish every young person could learn easily, something they could do? Maybe if someone is listening to this that has young children and maybe they're not the most financially educated individual, like my parents, our parents weren't, like, what can you do for your kids to, what's the one little thing that you can do to kind of help them learn something or help them improve, even if it's just, something small? Yeah. What would you advise?
Yeah, I think and this kind of goes back to my experience at, credit, et cetera, because that's yes, you want to budget. You absolutely need to budget and understand, you don't spend more than you earn, things on those lines. But yeah, I think once you get past that, the understanding the credit is so impactful across multiple areas of your life, right? And if you don't understand it, it can have detrimental impact to your life. So, to that point, one of the things that I wish I would have had then, which I do have now with Incent, which is a parental lending module. My daughter, she was about 8, 9 years old, and she came home one day, and I was starting to kind of just trying to help her understand like borrowing and things, because she had asked me to borrow some money. That's what it was. And I said, well, sweetheart, I said, you want to be careful with borrowing money, because generally you have to pay interest. And interest means that you're paying more to that person or that organization more than what the product was that you bought, right? But if you loan money out, well, you actually get money back, right? So you make your money work for you. So she came home one day and she said, hey, can you take me and Susie to ice cream? Get ice cream at Baskin Robbins. And my immediate response was always, yeah, I don't have any cash. And so that's why I said, I don't have any cash. She says, why don't you let me loan you some money? You pay me interest and we'll go get some ice cream.
Okay.
I said, oh, okay. I said, interesting. That's actually
you have to
not
say
how
yes.
It works.
You have to say yes.
But just because you thought about it, I'm going to take you and get your ice cream. So right. I would think that, one thing is, especially as, kids are getting ready to go into college, just help them understand credit, right? You're paying interest. And if you don't pay it on time, here are all the things that could happen. So just make sure you're paying your bills on time. And you can afford to do so. So that's the one piece that I think of that was applicable with my kids early, and me. Unfortunately, I didn't know that going into college, and it cost me. But I've turned it around. It's over 800 now, so I'm good.
Funny, it sounds like your daughter, she really studied your objections.
Yes,
and figured out a strategy to overcome the objection. I love that.
Yeah,
that's awesome.
Good. So, but thanks again, Mike. Really appreciate the time.
Absolutely, Marcell. This has been great. Thank you very much for sharing. I really appreciate it, and look forward to the next one.